Most of us that are gathering here today are confronted with one of the most serious situations of our lifetime. It's the impending monetary crisis that's on America. We could talk about a lot of other things, the nuclear threat, the cauldron of terrorism, Islam, a number of other things. But this one is confronting every one of us every day when we go to the grocery store or pay our rent bills, whatever. Possibly even losing our homes, maybe having lost a job and not having prospects of getting another one. We're in a serious crisis. We always in this country have bought more than we sell. We buy more than we sell, and that we always have done that. By the way, that's not new. And we finance the difference by debt. If we're buying more than we're selling, we have to borrow the difference. And we have. Our current imbalance, however, is over 1,000 billion per year. This will be more meaningful if I show it to you graphically. Back in the 1990s, we were negative. In fact, it approached about 100 billion negatively. That's a lot of money, and many people were concerned about that at that time. From 1997 on to the year 2000, it grew by 4 times that. That's the rate at which we're digging a hole. That's not the depth of the hole. That's the rate we dig deeper each year, 400 billion. And that concerned a lot of people. You saw a lot of thinkers writing papers and concerned about that at that time. In 2001, it picked up a little bit, and we breathed a sigh of relief, sort of. But in the subsequent years, it got worse and worse and worse, where it is now off the charts. We're talking literally 1 trillion, 1,000 billion per year that we buy more than we sell. We live at the largesse, if you will, of foreign lenders that lend us the money to continue. We act like we're the richest country in the world. No, we're the deepest debtor of the world. Big difference. And it's coming home to roost. In fact, the Federal Reserve, their primary measure of their performance is what's called the M3, a measure of liquidity. And if you're, as an economist, or if you took economics in college, you know the M3 is one of the primary report cards of the Federal Reserve. Well, it's interesting that in March of 2006, the Federal Reserve decided not to publish the M3 anymore. That's the report card. They just quietly elected not to publish it. And unless you're an economist, that went unnoticed. If you were an observer of the financial scene, it was an alarm signal. And so that's from that point on, we have experts try to guess what it probably is, rather than for the government to admit how it is. The U.S. financial report shows, the U.S. financial report is done on a cash basis. But as a footnote at the end, they indicate that if they apply it according to generally accepted accounting principles, that's called GAAP in the trade, your businesses aren't run just on cash. You also have to have your accruals, your payables that you owe the people, and that sort of thing. The generally accounted, the GAAP version of the federal budget shows that the assets are less than the liabilities. And in their words, put simply, the Office of Financial Report of the United States says, that the official financial report says that arguments that the U.S. government is bankrupt have increasing merit. That was 2 years ago. So that technically is what bankruptcy is if your liabilities are larger than your assets. And we crossed that, the U.S. government crossed that bridge 2 years ago. So the idea it's bankrupt, it sounds like a technicality to many people. Not to people who are lending you money, it's not a technicality. Are we seeing just the tip of the iceberg? Every day you look at the news or read the paper, you see more indications. Auto sales, of course, we're just taking the last couple of months of last year, down 37% year over year. An annualized rate of about in the neighborhood of 10 million units. That's a level that we had not seen for over 20 years. And so, anyway, it's depression-sized decline is the point I'm trying to get across here. Unemployment, jobless claims for the week ending December 6th, just before in the Christmas holidays, were down 500,000, the highest in 26 years and growing. That's continuing. Mass layoffs, making headlines on a daily basis in finance, in manufacturing, in retail, in construction, transportation, you name it. 182,000 layoffs from big corporations just in the month of 1 month that we're tracking here. All sectors are in a deep economic decline, laying off workers en masse. Industrial production in general, down, not growing, down 5.5% in the closing months of last year. Making it the worst quarters in 20 years. And consumer confidence, of course, continues to go down, so we're in a cycle here. The cash index fell it was 34 in November, down to about half of that, less than half of that in December, and continuing. University of Michigan publishes a consumer sentiment index at a 28-year low. Interest rates. Some like to point out that, the interest rates are going down, and that if they're virtually zero, and that they're going to turn around soon. We believe it's just the opposite, and I'll show you why. 0% interest rates are an ominous symptom, not a cure. In a recession, zero interest rates are stimulative. If you can borrow cheaply, you can invest in equipment, new businesses. In a depression, they are not. They're terrifying. That means no one's borrowing to repair anything, repair the economy. The National Bureau of Economic Research finally, late last year, at the end of 2008, admitted that the U.S. has been in a recession since the fourth quarter of 2007. That's one of those little lines you may see in a technical report, not realize the implication. But if the fourth quarter of 2007 was an economic contraction, then the fourth quarter of 2008 is an outright economic collapse. No one wants to use the D word. It's a depression that we're in, but no one wants to admit it. All the data points show that economic activity right here and right now is falling off a cliff in unprecedented fashion. Any belief that this is going to be a short and shallow recession or even a long and deep recession, but still a recession, is, in our opinion, woefully misguided thinking, wishful thinking. This is a depression, one that has only just begun. Something that most of us have never experienced in our lifetimes. Our parents and grandparents would know it well. They had the hardiness and the resolve and the sense of community to weather those kinds of storms. Investment survival. In 2008, there were 4 investment strategies that paid off and survived, at least for the time being. Cash, of course, that's if in the U.S. dollar. It had surprising strength in spite of the fact there was no basis for it. Government bonds were, that is at the Treasury level, didn't really crash last year, didn't do well, but they were safety. Gold, that's the physical, incorruptible store of wealth, surprisingly did exactly what it was supposed to. The other thing you could do if you were a sophisticated investor was to short, specifically in the stock markets, but any risky asset would have done nicely if you had shorted it, because most of them went down. The investment question, of course, continues, is what will be the winners in 2009, and I have yet to find anyone with a good answer to that. We monitor most of the sources here. This is a year when the financial crisis will have morphed into an economic crisis, not just a financial crisis, but an economic one. Big difference, more fundamental, affecting all of us. What about gold? It started last year at about $800, and now as it goes now, it's actually over $920, $940. In other currencies, it's done even better than the U.S. dollar. Gold has done exactly what it's supposed to do, protecting portfolios against carnage that was experienced in almost all other financial assets. Almost everybody's portfolio did poorly, held on the gold situation. Going into the Depression of 2009, it still might end up being, from an investment point of view, one of the few safe harbor assets. In Canadian dollars, it went up 23%. In Australian dollars, up 29%. In British pounds, up 34%. In Icelandic kroner, up 95%. Of course, that government went broke. But so the point is that gold has been doing exactly what it's supposed to do. But the tremors continue. Citicorp, which was not long ago America's largest bank, and General Motors, one of the major industrial things, both on the brink of collapse. Downey Savings and Loan collapsing. Home prices falling in 30 U.S. cities at the fastest rate in U.S. history. The multi-trillion Fed Treasury bailouts having absolutely no effect. I'll go over those. The International Monetary Fund's chief economist is warning that the worst of the financial crisis is still yet ahead of us. Most of the money that's been spent was bailing out friends at Wall Street. Over $8 trillion so far, not a few hundred billion that the press talks about. And that's $8 trillion. That's more than all the entire world with foreign currency reserves of $7 trillion. And the lion's share of this goes to Wall Street giants, Citicorp, Goldman Sachs, Morgan Stanley, JPMorgan, Bank of America, AIG, the insurers, and of course to the greed, corrupted executives who precipitated the crisis in the first place. Are we sending good money after bad is a question we all should be asking ourselves. Since October of 2008, the government has deposited $165 billion into 8 of the nation's largest banks. Okay? These banks are now worth $418 billion less than they were 4 months ago. In 4 months, those 8 banks have declined by over $400 billion. The government's preferred shares is worth at least $20 billion less than that. The rate of return is a minus 1,000%. The total lost among those banks since September 30th of last year is $335 billion. Each little box on the little chart on the screen represents $1,000 million. The total, Troubled Asset Recovery Program, TARP, from that program, monies were received by Bank of America, Citicorp, JPMorgan Chase, and Wells Fargo, just since September 30th. Against the $335 billion that they've lost, the government has given them $140 billion in the hopes of helping that turn around, right? Let's take a look at each one of these. The value before that handout of Bank of America was $159.7 billion, represented here by the same kind of squares. That was their value then. And they received TARP of $45 billion, and they presently are valued at $37.1 billion. In other words, the present value of Bank of America is less than the amount that they were handed by the government. That should give us some pause. That's a great job of management, huh? Let's look at Citicorp. Their value before the TARP was $110.4 billion. They were given also $45 billion. Their current value is $22.9 billion. In other words, about half of what the government gave them. So it's pretty pathetic, obviously. JPMorgan. Before the TARP, they were worth $174.1 billion, as represented again graphically here. They were given $25 billion to assist them, and their current value is $103.3 billion. So at least they're worth more than they were handed, but and their performance obviously on this measure is less drastic, but still disappointing. Wells Fargo, $124.7 billion before the TARP. They were given the smaller handout, the $25 billion handout, and they are worth, the present value is $70.5 billion. So they still had a $50 billion drop of value, in spite of the fact that they were handed $25 billion by the government. One of the most venerated of the economists has said just a few weeks ago, it has been estimated that continued losses, loan losses, will force U.S. banks to come up with an additional $1.4 trillion just to stave off bankruptcy. So, these $20 billion, $40 billion are just scratching the surface. It's going to take $1.4 trillion to stave off bankruptcy. Let's talk about the federal deposit insurance. Most of us get comfortable, well, our deposits aren't that large. They're guaranteed by the Federal Deposit Insurance Corporation. It's the surer. It insures $13.3 trillion in U.S. bank deposits in over 8,000 banks, almost 8,500 banks. They had less than $35 billion in insurance funds at the end of the third quarter of last year. That's only 76 cents for every $100 of insured deposits. In other words, less than 1%. So if there's a run on the banks, how much good is that going to do? How can they participate, say, and just take one GE Capital loan guarantee of $139 billion? They've only got, $35 billion total assets themselves. The FDIC is just cosmetics to keep the retail customer from running on his bank. That's the blunt reality there. So welcome to 2009. Here we are. The data so far is from last year. The data has only gotten worse. U.S. housing starts fell a further 15% in the final month, 500,000, lowest on record. U.S. industrial production fell another 2.2% in December, to a 7.8 year-over-year decline. European industrial orders, not just here, in Europe too. Their industrial orders, that's a leading indicator of industrial production, were down 26% year-over-year, largest decline on record. Japanese exports plunging 35% in December. Global steel production reported down 24%. Those are big numbers for declines. All over the world, there are dramatic rates of decline of economic activity being reported. You go on and on with the statistics. So what we've seen is probably just the tip of the iceberg. The U.S. stock market's off 50% so far. European markets off 55%. Emerging markets are off 65%. Russia's off 70%. Earnings for all the S&P 500 corporations dropped 22% just in the third quarter. Paul Volcker has gone public on his assessment. He says the economic slump has begun to metastasize after a shocking collapse in output over the past 2 months, threatened to overwhelm the incoming Obama administration. He made these remarks at the end of last year in November before the thing. What this crisis reveals is a broken financial system like no other in my lifetime. That's Paul Volcker's assessment. Normal monetary policy is not able to get money flowing. There's been a leveraging in the economy beyond imagination. The trouble is that even with all the government intervention, the market is not moving again. So some of these things might have made sense in November and December as we're starting to face this. As you get into January and February, we're beginning to realize that the effects it's not having any effect.